In today's video, we are going to look at building a policy specifically for income during retirement. Let's get on into it as we're going to have a lot of fun today. So what we've got is a case study where someone is about to turn 50 years old. He'll be 50, his wife will be 49 years old. We are going to look at policies for both the husband and the wife in this video when we look at the numbers, but he's just about 50 years old. He has plans for retirement. Specifically, his current plan involves the following. He'll have income from his dividend-paying stocks. He's got a 401k that's sizable, and then also he has an idea of what his Social Security will be. He's interested in whole life insurance primarily from a discussion with a friend of his who has some large policies and is also looking to use the policies in retirement for income. So what he is interested in specifically with whole life insurance is as follows. He wants to maximize the cash value component. For him, he wants to be able to generate $50,000 per year in income from his policy, and then $25,000 per year from his wife's policy. So that is an additional $75,000 per year that he wants to begin somewhere between age 62 and age 65. He's not certain right now, but once he turns that income on, he wants that to last indefinitely. So the benefits here, a big reason why he's attracted to it, has to do with the tax benefits around the cash value, provided we do not trigger a modified endowment contract or we don't lapse the policy or do anything that would trigger a taxable event. He can access that cash value, take the income specifically on a tax-free basis. So that's in addition to what he currently has planned. So that is his area of attraction. Now, quick side note, I did discuss with him some alternatives that often we'll look at with life insurance. For example, instead of just taking an income stream from life insurance, if you've got other income producing assets, specifically in retirement, what you could look at perhaps is spending down this faster, this 401k you have, letting the life insurance sit for a bit, and then once you deplete the 401k, you begin to come after the life insurance. Why some people like that is because the 401k is taxable. I do not have control over what will occur with taxes if tax rates go up or down during retirement. And also, if I'm concerned about leaving a legacy, a 401k is not the most efficient way to do that, just with the tax status around those dollars. So what some will do is look at their retirement assets and say, okay, let me look to spend this down faster because I do not have control over what can happen with taxes. And then after that's depleted, I'll replace whatever I was receiving in income on an annual basis with the cash value from my life insurance policies. I also have no risk with these, so I don't have to worry about any type of market fluctuation. So that was a discussion that was briefly mentioned. That is something that we do like to look at from a planning perspective. But to get back on track with this video, what we're going to look at is exactly what he wanted to see. That, what I mentioned earlier, sparked a little bit of interest, but still, he said, here's what I want to see. So let's look at this. Here's what we've got. What he asked for with respect to funding the policy was not, here's how much I want to pay in. Instead, it was, tell me how much I need to fund this policy with in order to generate the income I'm interested in. So, Steve, you tell me how much needs to go into the policies, and that's what I'll do. Specifically, what I'm interested in is funding these policies for 5 years. Now, where the 5-year funding period came from, because that's short, it's what his friend did. And he's in a position where he's cash flowing right now. He has some excess funds, and he's interested in getting money into a policy and then being done with it. He knows he can bank on this money for retirement in the future. That is his present mindset. Now, what he can also do with the policies is if he wants to continue to fund them after 5 years, similar to what his friend is doing right now, he can do that. But what we want to do today and what we're doing for him right now is showing him exactly what he asked for. So to back into the funding at age 50, the funding he'll need is approximately $130,000 per year for 5 years, which is a total of $650,000. And then for his wife, $75K per year for 5 years, which is a total of $375,000. So when I show you those numbers, do you feel like that will be enough? there's the question. Is this enough? Meaning, is this enough money for him to pay into the policy, or both policies, and then generate this type of income in retirement? How do I make sure that I have enough income? How do you, the potential policyholder, if you're interested in a policy, make sure that this type of funding actually works? What information is not seen that I'm looking at on the surface? I'm bringing this up because when it comes to planning with a life insurance policy, and specifically looking to take income, asking the right questions, particularly around illustrations, is very, very important. The best thing you can do is request an illustration with a conservative dividend or just based on the guarantees. That is a great way to see what things look like based on conservative rates, not the present dividend interest rate. Yes, dividends might go up in the future and that could result in the numbers looking better. But what if whatever happens and things go down, dividends that is, and you have less in cash value than what you anticipated? If you've got less in cash value, that'll produce less in income. We do want to ask the right questions here or have the awareness. So we're going to look at this. I'm going to go through what we showed him and what I really like to do in these types of situations. Now, let's talk about money going in first, because this did come up. Policy design and company choice. Company choice. I always talk about what? The 4 major mutuals, because we've seen proof of performance with them. Now, with respect to company selection, we looked at 2 of them here, MassMutual and Guardian. Let's take just the husband's policy. If he wants to fund $130,000 per year, company choice will give him some flexibility here when we look at MassMutual and Guardian. If he's comfortable with a one-time per year payment, meaning he says, hey, $130,000 every year, like that's fine. I'm comfortable with that. I don't need much flexibility. That's what I'm planning to pay, and I can handle that, especially knowing that I can have this type of income indefinitely in retirement. If he's comfortable funding that amount every year on his premium due date, MassMutual will work beautifully for him. He does have some flexibility on his premium due date. If he wants to adjust that downwards and then back up in some future years, he can do that without any underwriting. So he does have flexibility, but the key point here is one-time per year payments. That's the key with the way the MassMutual product is designed. Then with Guardian, what he can do if he wants more flexibility, he can commit to the minimum, which with the premium, term rider, and everything that involves the minimum is about $15,000 per year. And then he can add the rest of the $130,000 whenever he wants over the course of each year. He can do it through a mobile app, online portal, wire transfer, whatever he wants to do. So he does have a bit more flexibility there. In his particular case, he did express that he didn't really need it. So still, I want to show both options initially in the initial set of illustrations when we're going over different options. And then after he reviews everything, he can begin to narrow down his selection as far as what company and product he prefers. So let's take a look here. Whenever we look at income illustrations, what I like to begin with is growth illustrations. Meaning, what does the policy look like if I don't take any income from it? Where this can help you is when you begin to look at taking income from a policy, you can compare what the policy looks like if you don't touch it directly with the income policy. And now I can see how much did I pay in with the growth illustration, and then the income illustration, how much did I pay in, but then how much did I pull out? And specifically, how much money did I pull out in excess of what I paid in? I hope that made sense. You're going to see it. You're going to see a visual as we progress through this. So what we've got here is one product with Guardian and one product with Mass. Why you see 3 illustrations is because with the Guardian policy, we ran the basic dividend rate, and then also we illustrated their indexed rider, which what this does is grant a little bit greater earning potential on a whole life insurance policy. Guardian does offer this indexed rider. There are fees that are associated with that rider if I choose to exercise it. So we do want to go over the pros and cons there, which we've got other videos that do that. But when we look at income strategies, this sometimes is a rider of interest, so we do want to show it. And then if questions come up around that rider, we can spend as much time as needed really educating the individual on it. But it was something that I did want to show, as it provides a little bit of additional value to the Guardian policy, especially if he decides he wants the flexibility. Then we've got the MassMutual policy. We're looking at their 10-pay product. What that means is you can pay into it for a maximum of 10 years. That's how long the premium is due. But in these scenarios, we're looking at 5-year funding. That's what he wants to do. He had mentioned the 5-year funding a couple times. And again, that's because what a friend of his had done. His friend actually set it up in almost an identical manner to this. The funding was $130K per year. His friend started a little bit younger though, around age 45, and made his 5th payment at age 50. So with that said, we've got the different growth illustrations. What we'll look at for income now is this, the Guardian dividend illustration, and then this, the MassMutual income illustration. And then we'll look at the wife's. Now, the wife's, I'm going to show you something different with her policy, which is how I like to plan when we're looking at income. So let's take a look at his first, and I'll show you a potential danger here. So with Guardian, there's our growth illustration next to our income illustration. So for the first 14 years, is there any difference with these two? No, they're identical because it's the exact same policy. The only difference is in this example, in year 15, we start to take $50,000 per year in income. Specifically what we're doing, if we pull up the illustration, you'll see withdrawals up to our cost basis, which is our total payment, $650,000, and then loans afterwards, where we are not paying any loan principal or loan interest. That is how we can continue to take our money out tax-free, provided the policy does not lapse. But when we look at this, what do you notice? Income starts at age 64, that's year 15, and we take $50K out per year. By age 76, why this column in black, which is called total funding, is at 0? Because he's pulled out a total of $650,000. He paid in $650 over 5 years, and then at $50K per year down here, at age 76, he's taken out $650,000. Therefore, his net input into the policy is 0. Now, as he continues to take $50K per year, we see it in the red here, and what this represents is how much more money he's gotten out of the policy in addition to his initial $650,000 input. So I got my money back and this much more, whatever I see in red. And then to the far right, you've got the cash value and net death benefit. So we ran income through age 100. What do you notice here though? And you'll see this on the illustration as well, where it gets a bit wacky down at age 97. Now, some people say, who cares? I'm not going to be around at 97. I'm not concerned about that. But this is something we want to have awareness on, because the dividend rate goes down or the performance is impacted and negatively at all, this could occur a bit earlier. If it occurs in my late 80s, this could be a problem. So what's happening here, the last year, 97, $41,000 in change in income is taken from the policy, not 50. That's the maximum dollar amount that can be taken without the policy lapsing. But then what happens, look how low that cash value is. The next year, age 98, there's not a negative sign there. What this means is we have to pay $14,000 in change, almost 15K, in order to prevent the policy lapse. Age 100, it's even higher. So again, do we need to worry about this because it's so late? Some people would say no, but at the same time, if we don't pay this and we're still living, the policy will lapse. Then what happens is we'll have a large tax bill. Because if a policy lapses with a large loan outstanding, the company is going to look at your original cost basis, which was $650,000. But then they'll look at how much you took out in withdrawals, which was $650,000, plus the additional amount in loans, which will be another $1 million. So that's the gain, if we want to call it that, call it $1,040,000, but then also the loan interest that has accrued over time. That's added to the loan balance. That's not on the spreadsheet. You'll see this in the full illustration. That can be included, or will likely be included in the 1099. So we do have to have awareness on this. Now, the good news is that this is very, very easy to forecast well in advance with an active policy, not just an illustration, but once you've got one in place, and then we can easily prevent it by having regular discussions and regular review meetings. But we don't want something like this to surprise someone down the road, because that's not good to get a big tax bill like that. Because if it doesn't lapse, whatever's left over in death benefit is paid income tax-free to our beneficiaries. But that is our guardian illustration. And what I would look at here is one of two things to ensure he can get the income he'd like out. One, have a discussion with him, and if he feels, hey, age 90, I'm probably not going to take the $50,000 any longer than that. I'm not sure that I'll be around at age 90. Then I would feel comfortable with this policy, because at $50K per year, based on the present dividend rate, got $440,000 in cash value. Even if the dividend goes down over this long period of time, 40 years, I should still have sufficient cash value where I'm not at a risk of a lapse occurring. Now, if he says, hey, I want to make sure that I don't run into any risk through age 100, then what I would do is recommend a bit higher funding, and would then run that higher funding with a reduced dividend scale. This way I can look at things conservatively. We're going to look at a conservative example in just a couple minutes here. First, let's look at the MassMutual illustration for him. We've got the growth one to the left, income to the right. How does this one look? This is healthier. However, something very important to mention here. Got a lot of cash value, but this is run with a variable loan interest rate. So if you've got a variable rate, what can happen with that? Well, the interest rate can go up. If you're not paying the loan interest, which we're not in these examples, how is it paid? The policy will take a loan against the cash value to cover that loan interest. That will slow down the performance and result in you having less cash value here. So that's important to note. Whereas the Guardian product we ran has a fixed loan interest rate. That's fixed for the life of the policy, provided we don't change it to variable at year 10. But now we've got some different scenarios. Main thing is we backed into that funding of 130, and we're very close. If he wants to look at it more conservatively and says, I definitely want to be able to take income through age 100 in case I'm still living, like I don't want to run any risks with this policy, just tell me how much I need to pay into it, I would increase that funding a bit, somewhere between 135 and 150 at the highest if he's extremely conservative. But 135, 140 will likely do the trick when we run a reduced dividend interest rate, because you're paying in another $5,000 to $10,000 per year for 5 years. So that's $25,000 to $50,000, and then letting it compound up until age 64. So you're letting it sit and grow for a while. So that does give you a nice advantage there. Let's look at the wife's policy, and we will wrap up with this. So what we've got, same thing with the growth illustrations. Guardian on the left, MassMutual on the right. Nice break even with the wife's, year 4. And here we go. So here's Guardian. He wanted to see income of how much for her? $25,000 per year. Now they're about the same age, him and his wife. He's 50, she's 49. We could just cut the numbers in half and look at funding for her of $65,000 per year, and it'll be very, very similar to what we saw with his policy, but cut in half. And you'd be able to generate the $25K per year. You would just see that same problem we saw around age 97. Maybe it'd be 98 with her. Instead, what we did here was run things more conservative. Instead of funding $65K per year, which we know will work, we looked at $75K per year. So then, when we scroll down here and look at the income beginning at year 15, $25K per year, what happened? We've got sufficient cash value left over. So here with MassMutual, you've got your 10 pay, there's growth, 10 pay, there's income, $25K per year. Even if we kick the interest rate up or the dividend down, you've got a healthy amount of cash value left over here down at age 100. So what you could do here, and this is a nice way to test a policy, is here's another illustration, the exact same policy, but with $30,000 per year in income. Now what happens? I get a lot more out, but that cash value is getting much, much lower as a result. That's closer to the danger zone where if dividends go down or the loan interest rate goes up, I'd be a bit uncomfortable with that. However, what it tells me is if his goal is to generate $25,000 per year in income for his wife's policy, this funding of $75K per year, we're building in a nice buffer here with either Mass or Guardian. And we can run a conservative dividend or adjust the loan interest rate upwards and still see it produce the income we want or very close to it. The main purpose of these illustrations and this video is to answer this question. How much do I need to pay into the policy in order to generate the desired income? Tell me how much I need to fund. So we've got the dollar amounts. For the husband at 130, that should work. If it's me personally, I might kick that funding up a little bit, and that is a conversation we will have. That is a message I will communicate. And then for the wife, an example of $75K per year, but know that you can scale that down a little bit if you'd like. So that's always a nice way to approach income strategies with life insurance. This way I'm planning it more conservative, because the biggest issue that occurs with cash value life insurance sales in general is the illustration is displaying beautiful numbers, and then reality produces a number that's much lower than what was projected. Like, that's what no one wants. We don't want to overpromise and underdeliver. More conservatively, yes, I might have to fund a little bit more, but it puts me in a position where the product can accomplish the goals that I'd like it to accomplish. So I hope you enjoyed this video. Please let us know if you did and if you have any questions at all. And as always, I hope this helps. Thanks so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.